Good morning all. Myself Dr. Priyanka Ghosh. Today we are going to talk about the valuation of goodwill. So before going to in depth of valuation of goodwill, what are the different methods we are having? Let's start with the discussion of the definition of goodwill. So what is the basically goodwill is? Goodwill is the brand value or the reputation of the company. We know that we are having two type of assets. One is tangible asset, another one is intangible assets. So tangible asset means what we can feel, we can see, but intangible asset we cannot feel or we cannot see. So goodwill is one kind of intangible assets. Though goodwill is an intangible asset, but it is a real asset, and always goodwill will exist with the business. But there are several factors which will affect the goodwill, like the company will do the business in which place they are doing the business, which kind of doing their business, what are the different kinds of products they are preparing, what is their customer base. So all this will depend on that. The goodwill will be varying. So if the company is having good customer base, they are having good product quality, then goodwill will be increasing. If the company doesn't have the good quality of the products, good customer base, then goodwill will not create. So when goodwill will create? So when the sole proprietorship will transfer to the partnership, or in case of partnership, suppose any partner will come into the business or any partner will retire from the business. In those all situations, the goodwill will be created or calculated. So next one, we are talking about the valuation of goodwill. So we are having four kinds of methods to calculate the goodwill. One is average profit method, second one is capitalization method, third one is super profit method, last one is annuity method. So among all these four methods, the super profit method we are going to talk about. So if we are going to calculate the goodwill under super profit method, we are having some 6 steps to follow. First step is calculation of adjusted profit. So here first we need to calculate the adjusted profit. Now what is the meaning of this adjusted profit? So when the questions they will give you, sometime what will happen, the owners or the company, they forgot to adjust some of the expenses or income. So if the sum of the expenses or income they forgot to adjust with the profit or record into the profit and loss account, so before calculating goodwill we need to adjust or record in the profit and loss account. And after adjusting those income and expenses only, we can find out the adjusted profit. So it is not like fixed that every time this adjustment will come, but it depends. If adjustments will be there, means we can go with the calculation of adjusted profit. Second step, after calculating the adjusted profit, we need to calculate the average profit. So based on the adjusted profit, we need to calculate average profit. So to calculate average profit, we are having two methods. One is simple average method, another one is weighted average. So simple average method means after calculating the adjusted profit, we need to see the trends of the adjusted profit. So here, if the profit trends are there up and down, in those cases we should go for the simple average. Simple average means add all the adjusted profit divided by number of years. Suppose if in the case of adjusted profit only increasing trends are there, then in those cases we should go for the weighted average profit. So in case of weighted average profit, it is we have to assume some weights and we have to multiply the weights with the profit, and then we can find out the average profit. Formula for weighted average profit will be total weighted profit divided by total weights. Step 3, calculation of average capital employed. So after average profit, we should calculate the average capital employed. So before calculating the average capital employed, here all we should remember that if fixed asset and current asset, whatever we are considering, if in the question they have given you the market value, we should consider the market value. Suppose in the question they did not mention anything about the market value, then obviously we should go for the book value or balance sheet value. So the formula for average capital employed will be fixed asset plus current asset. So here any kind of investment we are not going to consider. Fixed asset plus current asset minus current liabilities. Current liabilities means here we are talking about the creditors, bank OD, debenture holder or any kind of loans. So after calculating fixed asset plus current asset minus current liabilities, we will be getting total capital employed. So from total capital employed, we need to minus half of the current year's adjusted profit. So half of the current year's adjusted profit, current years means which year? Current years means we should consider the last year's adjusted profit. After calculating the average capital employed, we should calculate the normal profit. How to calculate normal profit? Formula is that average capital employed into normal rate of return. Step 5, after calculating the normal profit, we need to calculate the super profit. Now, what is this super profit? Super profit, it is the extra profit over the normal profit the company will earn, which will help the company to create the goodwill. So here super profit, how to calculate? Average profit minus normal profit, we will be getting the super profit. Last step, we will calculate the goodwill. So here we are considering the purchase of super profit. So if we are considering the purchase of super profit, the valuation of goodwill formula will come super profit into number of years of purchase. So these are the steps, 6 steps we are following to calculate the goodwill. Let's see one example for under super profit. So from the following particulars, we need to calculate the value of goodwill based on 3 years purchase of super profit. So here number of year of purchase, they already told into the question that 3. So they have given last 4 years profit. So along with that, they have given fixed asset rupees 8 lakh, current asset 80,000, current liabilities 1,60,000. Normal rate of return, they have mentioned 15%. Managerial remuneration, if employed elsewhere, it is rupees 10,000 per annum. So what is the meaning of that? Meaning of this line is that there is a manager's salary and they forgot to adjust with the profit. So as we know that manager's salary is our expenses, so always all the expenses we should minus it from the profits. So here the 4 years profit is given 1,20,000, 1,40,000, 1,30,000 and 1,50,000. So from all these profits we need to adjust the manager's salary or remuneration. So let's see how we can calculate the value of goodwill step by step. So this is the step 1. So we can follow as per the format. So step 1, calculation of adjusted profit. So here I have made 5 columns, particulars along with that 4 years. So I started with the profits for the year, which is given into the question itself. First year 1,20,000, second year 1,40,000, third year 1,30,000 and fourth year 1,50,000. So this is the profits they have given into the question itself. From there, if you'll see in the question, we are having one adjustment, that is manager's salary. Manager's salary as business expenses, so I have deducted 10,000 rupees per annum from each year's profit. So 1,20,000 minus 10,000, first year adjusted profit will come 1,10,000. Second year adjusted profit will come 1,30,000. Third year it will come 1,20,000 and fourth year it should be 1,40,000. So this is my step 1, calculation of adjusted profit. So after calculating the adjusted profit, next we should proceed for the average profit. So as I mentioned, before proceed for the average profit, we should check the trends of the adjusted profit. So if we can see the trends in step 1, adjusted profit, we can see first year adjusted profit 1,10,000, then 1,30,000, then it has reduced to 1,20,000 and then again it is increased by 1,40,000. So we can understand that in that we are having up and downs in the profit or fluctuations are there. So if fluctuations are there, obviously we should follow the simple average method. So in step 2, we calculated average profit by using simple average profit formula. So the formula for simple average is that total adjusted profit divided by number of years. So I have added all the adjusted profit 1,10,000 plus 1,30,000 plus 1,20,000 plus 1,40,000 divided by number of years are 4. So we got average profit is 1,25,000. After step 2, we can proceed for the step 3. So step 3, we need to calculate the average capital employed. So formula I have already mentioned, fixed asset plus current asset. So if market value is given, we should consider market value. Other than that, we should go ahead of the balance sheet value. Fixed asset plus current asset minus current liabilities. So fixed asset, they have given 8 lakhs plus current asset in the question itself they have given 80,000. So total asset we got 8,80,000. From there I have deducted current liability 1,60,000. So capital employed at the end it has come 7,20,000. If we look into the formula, total capital employed we got 7,20,000. From there, if you want to calculate average capital employed, we need to minus half of the current year's adjusted profit. So half of the current year's adjusted profit means, as I mentioned, always we need to consider the last year adjusted profit. So if you can see in the step 1, last year adjusted profit is 1,40,000. So here half of the current year's profit I have deducted. 1,40,000 divided by 2, 70,000 is the answer. So 7,20,000 total capital employed minus half of the current year's adjusted profit 70,000. We got average capital employed 6,50,000. So this is the answer for step 3. Now we can proceed for step 4. So step 4, calculation of normal profit. So how to calculate normal profit? Formula is that average capital employed into normal rate of return. So average capital employed in last step we have calculated 6,50,000 and into 15%. It is given into the question itself, normal rate of return. So we got normal profit is 97,500. After calculating normal profit, we need to calculate the super profit. So super profit formula is average profit minus normal profit. So average profit in step 2 only we got 1,25,000 minus 97,000 is my normal profit. So we got super profit or extra profit, that is 27,500. Step 6, so we calculated the value of goodwill. So as I informed you, we have considered the years of purchase of super profit. So formula is super profit into number of year of purchase. So as in the question itself they have given 3 years of purchase. So 27,500 into 3, we got total value of goodwill 82,500. So in this PPT we have considered the definition of goodwill. What are the different features of goodwill we are having? What are the different factors it will